Hi everyone, and welcome. Today we're covering two indicators found on almost every trader's chart: the average true range and the stochastic oscillator. By the end of this lecture, you'll know how to read both in real time and combine them into practical trading techniques. Let me give you the roadmap so you know where we're headed. We're going to break this into four main parts. First, I'll give you the big picture idea, the one sentence that will help everything else click into place. Second, we'll spend a good chunk of time on ATR, what it is, how to read it, and 3 practical ways traders use it. Third, we'll do the same thing for stochastics, what it is, how to read overbought and oversold conditions, and how to spot crossovers and divergence. And fourth, this is the part I'm most excited about, we'll combine the two indicators into complete trading techniques. Because on their own, each indicator only tells you half the story. Here's the one idea I want you to hold on to through this entire lecture. ATR and stochastics answer two completely different questions, and that's exactly why they work so well together. Think of ATR as the market's speedometer. It doesn't tell you if the car is going forward or backward, it just tells you how fast it's going, how bumpy the ride is. A stock can be calm and barely moving, or it can be wild and swinging by huge amounts. ATR tells you which situation you're in. Stochastics, on the other hand, is more like a compass near a cliff edge. It tells you whether price has stretched pretty far in one direction relative to its recent range and whether momentum might be running out of steam. But it raises pay attention to movement. The other measures position and momentum within a range. Speed versus position. Keep that distinction in mind, and everything else today will make a lot more sense. Let's start with ATR. Average True Range was developed by a technical analyst named J. Wells Wilder back in the late 1970s, and it's stayed relevant for almost 50 years because the idea behind it is so simple and so useful. Here's the core concept. ATR measures how much an asset typically moves over a given period of time. That's it. It does not tell you whether price is going up or down. If someone tells you the ATR just went up, that does not mean the stock is bullish or bearish. It just means the stock has been moving around more violently, in either direction. Think of it in plain dollar or point terms. If a stock has an ATR of $2, that means, on average, over the recent period, this stock has been moving about $2 a day from its low to its high. A stock with an ATR of 20 cents is a quiet, sleepy stock. A stock with an ATR of $10 is a wild one. Neither is good or bad, they're just different personalities, and ATR lets you measure that personality objectively instead of guessing. Now, I promise this won't turn into a math lecture, but it helps to understand the logic, because it explains why ATR works the way it does. For any single day, the true range is the largest of 3 possible values: the difference between today's high and today's low, the difference between today's high and yesterday's close, or the difference between today's low and yesterday's close. Why 3 options instead of just high minus low? Because of gaps. Imagine a stock closes at $50 and then opens the next morning at $55 because of some overnight news and trades in a tight range all day. If we only looked at that day's high minus low, we'd think it was a quiet day, but it wasn't the price gapped $5 overnight. True range captures that gap. Once we have the true range for each period, ATR is simply a moving average of those values, typically over 14 periods. The good news is you will never have to calculate this by hand. Every charting platform does it for you instantly. What you need to know is what the number represents and how to read it, which is exactly what we're covering next. This is where ATR becomes genuinely useful, so let's slow down here. First rule, look at whether ATR is rising or falling, not just its raw number. A rising ATR tells you the market is becoming more volatile, bigger daily swings, often around news events, earnings reports, or periods of uncertainty. A falling ATR tells you things are calming down, prices coiling into a tighter and tighter range. Second rule, and this trips up a lot of beginners, ATR numbers are not comparable across different assets. An ATR of $5 might be enormous for a $20 stock, but tiny for a $2,000 stock. So instead of asking, is an ATR of $5 high or low, always ask, is this higher or lower than usual for this particular asset? You're comparing the indicator to its own recent history, not to some universal benchmark. Some traders convert ATR into a percentage of price specifically so they can compare volatility across different assets fairly. But for now, just remember, context matters more than the raw number. Third, watch for extremes. A sudden spike in ATR often follows a shock earnings, news, a market-wide sell-off. A prolonged period of low, flat ATR often means the market is in a quiet sideways holding pattern. Both situations set up different opportunities, which brings us to our first practical technique. Here is the first real practical way traders use ATR, setting stop losses that actually make sense. A lot of beginners set a stop loss using an arbitrary rule, like I'll risk 50 cents or I'll risk 2%, no matter what stock they're trading. The problem is that this ignores how much the stock naturally moves around. If a stock's ATR is $1.20, meaning it commonly swings over $1 a day just from normal noise, and you set a 50-cent stop, you're almost guaranteed to get stopped out by completely normal price action, not because your trade idea was wrong, but because your stop was too tight for that stock's personality. Here's how an ATR-based stop works instead. Let's say you buy a stock at $50, and its ATR is $1.20. A common approach is to place your stop somewhere between 1.5 to 2 times the ATR below your entry. 2 times ATR here would be $2.40, so your stop would sit around $47.60. That gives the trade enough room to breathe through normal daily noise, while still protecting you if the move genuinely goes against you. The beauty of this approach is that it automatically adjusts. Trade a quiet stock, and your stop sits close to your entry. Trade a wild stock, and your stop naturally sits further away. You're no longer using one-size-fits-all rules, you're letting the market's own behavior tell you where a reasonable stop belongs. The second technique follows naturally from the first, using ATR to decide how many shares or contracts to trade so that your dollar risk stays consistent no matter which asset you're trading. Here's the problem this solves. Imagine you decide you're comfortable risking $100 on any single trade. If you trade a calm stock with a small ATR and use a stop based on 2 times ATR, that stop might only be 50 cents away, so you could buy a fairly large number of shares and still only risk your $100. But if you trade a volatile stock with a large ATR, that same 2 times ATR stop might be $4 away. If you bought the same number of shares as before, you'd be risking way more than your $100 limit. So the formula is simple in concept. Take the dollar amount you're willing to risk and divide it by your ATR-based stop distance. That tells you how many shares keeps your risk consistent. Say you're willing to risk $100 and your stop distance is 2 times the ATR of $1.20, so $2.40. 100 divided by 240 is about 41 shares. Trade a calmer stock with a 50-cent stop distance, and that same $100 risk allows you 200 shares. This is one of the most underrated uses of ATR. It's not flashy, but it's the difference between position sizes that make sense and position sizes that quietly blow up your account on the first volatile stock you trade. Our third technique is a bit more forward-looking. Volatility tends to move in cycles, periods of calm followed by periods of expansion, back to calm, and so on. Markets rarely stay quiet forever. When you see ATR sitting low and flat for an extended stretch, that often means the market is coiling, trading in a tight, indecisive range, sometimes called a squeeze. Experienced traders pay close attention to these periods because a prolonged squeeze often precedes a sharp expansion in volatility, meaning a bigger move than the recent quiet period would suggest. Here's the important caveat. ATR only tells you volatility is likely about to expand. It does not tell you which direction the breakout will go. That's a crucial point, and it's exactly why we'll pair ATR with other tools later in this lecture. For now, just remember the pattern. Watch for ATR, sitting unusually low relative to its own recent history, and treat that as your cue to pay closer attention, not necessarily to enter a trade, but to be ready. Let's pause and recap before we move to our second indicator. ATR measures how much an asset moves, not which direction it moves. A rising ATR means bigger swings. A falling ATR means the market is calming down. And we covered 3 techniques. Using ATR to set stops that adapt to each asset's natural noise. Using ATR to size positions so your risk stays consistent across different trades. And using ATR to spot quiet periods that often precede bigger moves. Now, notice something. ATR never once told us whether to buy or sell. It's purely a volatility and risk management tool. So now, let's bring in an indicator that actually helps with timing and direction stochastics. The stochastic oscillator was developed by a trader named George Lane, and the idea behind it is actually pretty intuitive once you hear it explained. The core observation is this. When a stock is in a strong uptrend, it tends to close each day near the top of that day's trading range. When it's in a strong downtrend, it tends to close near the bottom of its range. Stochastics measures exactly this, where the current closing price sits relative to the high-low range over a recent look-back period, usually the last 14 periods. The result is a number that oscillates between 0 and 100. A reading near 100 means price closed near the top of its recent range. A reading near 0 means it closed near the bottom. That's the whole concept in a nutshell. Stochastics isn't measuring price itself, it's measuring times where within its recent range times the price is closing, which turns out to be a really useful proxy for momentum. Let's briefly look at the 2 lines you'll actually see on your chart, because you'll hear these terms constantly, %K and %D. %K is the raw calculation it takes today's closing price, subtracts the lowest low of the last 14 periods, and divides that by the total range between the highest high and lowest low of those same 14 periods, then multiplies by 100 to get a percentage. Quick mental example. If over the last 14 days a stock's range was between $40 and $50, and it just closed at $48, it closed pretty close to the top of that range, so %K would be around 80, a high reading. %D is simply a smoothed, moving average version of %K, usually averaged over 3 periods. It acts like a signal line, similar to how a moving average smooths out a jumpy price chart. On most platforms, you'll see the standard settings written as 1433, referring to the look-back period, the smoothing, and the signal line period. You don't need to calculate any of this by hand. Your platform draws both lines automatically. What matters is knowing that %K is the faster, more reactive line, and %D is the slower, smoother line that helps confirm signals, which we'll use in just a moment. Now for the interpretation that most people learn first, and also the one that's most commonly misunderstood. When stochastics is above 80, the asset is considered overbought, meaning price has been closing consistently near the top of its recent range. When it's below 20, it's considered oversold, closing near the bottom of its recent range. Here's the critical warning I want to give every beginner. Overbought does not automatically mean sell now, and oversold does not automatically mean buy now. In a strong, healthy uptrend, stochastics can sit in overbought territory for a long time, while price keeps climbing higher and higher. If you sold every single time you saw an overbought reading during a strong trend, you would have missed enormous moves and fought against the trend the entire way. So think of overbought and oversold less as buy and sell buttons, and more as alerts they're telling you price has stretched toward the edge of its recent range. Pay closer attention here. What you do with that alert depends on the broader context, which is exactly what our next 2 slides help you refine. The next reading to understand is the crossover between the 2 lines. When the faster %K line crosses above the slower %D line, that's traditionally read as a potential bullish signal, momentum may be turning upward. When %K crosses below %D, that's read as a potential bearish signal, momentum may be turning downward. This is very similar in spirit to moving average crossovers, if you've encountered those before. Here's the refinement that makes this signal genuinely more useful. Crossovers are considered stronger when they happen within the overbought or oversold zones, rather than out in the middle, neutral area of the chart. A %K line crossing above %D while both lines are down below 20 deep in oversold territory is a much more meaningful signal than a similar crossover happening up around 50, in no man's land. Traders often describe this as the indicator turning up from oversold or rolling over from overbought, and those specific setups tend to get a lot more attention than crossovers happening in the middle of the back. Range. The last reading I want to cover is called divergence, and it's one of the more advanced but genuinely powerful concepts in this whole lecture. Divergence happens when price and the stochastic indicator disagree with each other. Here's bullish divergence. Price pushes down to a new, lower low, but stochastics, instead of also making a new low, actually makes a higher low than its previous one. What does that tell you? Even though price is still falling, the momentum behind that fall is weakening. Fewer sellers are pushing it down with the same force as before. That's often an early warning sign that a downtrend may be losing steam. Bearish divergence is the mirror image. Price pushes up to a new higher high, but stochastics makes a lower high than before. Price is still rising, but the underlying momentum pushing it there is fading. One honest caveat: divergence can appear well before an actual reversal happens, and momentum can stay weak for a while before price actually turns. So divergence is best treated as an early warning to tighten your attention, not a precise, instant trigger. This is exactly the kind of situation where pairing stochastics with ATR becomes really valuable, which brings us to the heart of today's lecture. This is where everything comes together. Let's walk through a complete, simple framework that uses both indicators for what each one does best. Imagine a stock is in a broader uptrend, but it pulls back for a few days. During that pullback, stochastics drops down below 20 into oversold territory. Then you see %K cross back above %D, right there, inside the oversold zone. Based on what we covered a moment ago, that's a reasonably meaningful bullish signal. Momentum may be turning back up in the direction of the larger trend. So stochastics has just answered the when question. This looks like a reasonable moment to consider entering. Now ATR steps in to answer the where question for risk management. Let's say the stock's ATR is 90 cents. You enter at, say, $30 and place your stop around 1.5 to 2 times the ATR below that. So somewhere between roughly $1.35 and $1.80 below your entry, call it around $28.50. That stop gives the trade room to breathe through normal daily noise, while still protecting you if the pullback turns into something more serious. Notice how naturally these two indicators divided the labor. Stochastics helped time the decision. ATR helped manage the risk on that decision. Neither one alone gives you the complete picture together. They do. Here's a technique that will save you a lot of frustration, especially as a beginner. Stochastics has a known weakness. In choppy, sideways, low volatility markets, it tends to generate a lot of back and forth crossovers that don't lead anywhere. Traders often call this whipsaw. Price bounces around in a tight range. Stochastics swings from overbought to oversold and back again rapidly. And if you acted on every single crossover, you'd get chopped up by fees and small losses without ever catching a real move. This is exactly where ATR earns its keep as a filter. Remember from earlier that a low, flat ATR often indicates the market is stuck in a quiet, directionless range. So before trusting a stochastic signal, take a quick glance at ATR. If ATR is unusually low and flat, treat any stochastics crossover with extra skepticism. It's more likely to be noise inside a range rather than the start of a real move. If ATR is at a more normal or elevated level, and especially if you've recently seen it expanding, that same stochastic signal carries more weight because there's actual movement backing it up. This one habit, glancing at ATR before acting on a stochastic signal is a simple but genuinely effective way to filter out a large share of the false signals that trip up beginners. Let's put together one complete, simple plan that uses both tools from start to finish, because that's ultimately the goal of today's lecture. Step 1. Identify the broader trend direction. Using simple price structure or a moving average, we want stochastic signals to work with the trend, not against it. Step 2. Wait for stochastics to reach oversold in an uptrend or overbought in a downtrend, and look for the %K and %D crossover inside that zone as your entry trigger. Step 3. Before entering, check ATR. Make sure it isn't sitting at an unusually flat, quiet extreme, which would suggest a higher chance of a false signal. Step 4. Once you enter, set your stop using an ATR multiple, commonly 1.5 to 2 times ATR, placed on the other side of your entry from the direction you expect price to move. Step 5. For your target. Many traders also use an ATR multiple, for example, aiming for 3 times ATR in profit, which, compared to a 2 times ATR stop, gives you a favorable risk-to-reward ratio of 1.5 to 1, meaning your potential gain is 1.5 times your potential loss. That's a complete framework. Trend for context, stochastics for timing, ATR for both your stop and your target. Nothing overly complicated, but each piece is doing a specific, well-defined job. Before we wrap up, let's go through the mistakes I see beginners make most often with these 2 indicators, so you can sidestep them. Number 1. Trading every single overbought or oversold reading as an automatic signal. As we discussed, in strong trends, these readings can persist for a long time, and acting on everyone will put you on the wrong side of major moves. Number 2. Ignoring the broader trend entirely. A stochastic signal in the direction of the larger trend is simply more reliable than one fighting against it. Number 3. Using the same fixed stop-loss distance no matter what you're trading. This is exactly the trap ATR solves. A stop that works for a quiet stock will get you stopped out constantly on a volatile one, and a stop sized for a volatile stock will be way too loose on a quiet one. Number 4. Constantly tweaking indicator settings, hunting for the perfect combination that would have worked perfectly on past data. This is a trap known as over-optimization, and it usually leads to settings that were curve-fit to history, but don't hold up going forward. The standard settings we discussed today, 14 periods for both ATR and stochastics, are standard for good reason. And number 5, probably the most important one, skipping position sizing and risk management altogether. No indicator, no matter how well you read it, replaces the discipline of only risking an amount you're truly comfortable losing on any single trade. Let's bring it all together. ATR measures volatility, how much an asset typically moves, and we used it for 3 things: setting stops that adapt to each asset's natural noise, sizing positions so our risk stays consistent, and spotting quiet periods that often come before bigger moves. Stochastics measures momentum where price is closing relative to its recent range, and we used it to read overbought and oversold conditions, spot crossovers, and recognize divergence as an early warning sign. My honest advice as you go practice this: start on a demo account, pull up a chart, add both indicators, and just watch them for a while before you act on anything. Get comfortable recognizing the patterns we talked about today: oversold crossovers, divergence, ATR, squeezes, in real time, at your own pace, with no money on the line. Thank you so much for spending this time with me today. I hope you leave with a much clearer, more confident way of reading what your charts are actually telling you. Good luck out there, and happy charting!